Two of Singapore's largest banks have spelled out the damage the pandemic has caused to their balance sheets. A net profit for DBS and UOB slipped by double digits in the second quarter. Both banks are preparing to recoup less from loans. But analysts are still bullish, saying the previous prop up the bank's balance sheets in a period of low interest rate margins. Michelle Teo has more.
Singapore's largest lender saw net profit for the second quarter come in at 1.25 billion Singapore dollars, a 22% slide from a year ago. Net interest margin, a measure of banks' profitability, fell by 24 basis points to 1.62 from the previous quarter, and the bank expects this to go down further for the full year. Total income for the quarter was flat at 3.73 billion Singapore dollars due to declines in both net and fee income, even as that for the first half of the year jumped 7%. DBS CEO Piyush Gupta expects this to be much lower in the second half, despite costs being kept stable.
We will obviously continue to review our cost structures as we go forward for a challenging environment. But it is also important to point out that we are cognizant of our responsibility as a responsible corporate citizen in this difficult environment. And therefore, we really don't have any intent to cut jobs through the course of this year.
These sentiments were echoed by UOB's CEO Wee Ee Cheong, who said the bank aims to keep a stable cost-to-income ratio. That's amid a 40% slide in its second quarter net profit to 703 million Singapore dollars due to lower margins and higher credit costs. The bank intends to address this by looking at each company's cash flow and business model to determine if they can help firms restructure their loans. UOB's net interest margins slid by 23 basis points from the last quarter to 1.48%, while total income for the bank fell 12% to 2.26 billion Singapore dollars. This marks the second consecutive quarter that profits have declined for the two banks. Bad loan ratio for both banks was unchanged from a quarter ago, but both have allocated higher provisions to account for potential loan losses. Analysts say this move puts them in a position of strength to deal with growing uncertainties and is unlikely to cause any negative impact to their share prices.
Given that the banks have used this opportunity to aggressively build up reserves, it seems that they are in a better position. They already had good reserves, but then they have further built upon it. So it seems that they are in relatively better shape to withstand the asset quality downturn that's likely to happen.
In line with guidance by the central bank for local lenders to moderate their dividends for this year, DBS will pay a dividend of 18 cents per share for the second quarter, while UOB will pay 39 cents per share.